Why would anyone pay a premium to acquire a mortgage that's in default? Well, the answer to that is simple when you understand the true motivation of the bank. In 2 weeks, two of the top investment firms in the country are set to close a deal with Fannie Mae for a portfolio of deeply distressed debt totaling a staggering $285 million. And they're set to pay top dollar, almost 100% of the loan's unpaid balance. So why would they pay so much for loans that are deep in default? It's because they're not paying top dollar to acquire the loans. They're paying for the real estate it's secured by. They're basing their entire bid on the broker's price opinion, or BPO. Look at the numbers right here on the press release. The weighted average BPO loan-to-value ratio for these pools was around 49 and 50%. This means the unpaid loan balance is only about half of the property's estimated market value. They're acquiring a massive equity position in over 1,000 properties for only 50 cents on the dollar. This provides a huge cushion and gives these firms two clear paths to profit with minimal downside. The first one being a reinstatement. These companies now own a mortgage with a very low loan-to-value ratio. That puts immense pressure on the borrower to begin paying on their mortgage, because if they don't, they'll lose their property and their equity. And if the bank succeeds in getting these loans reinstated, they've turned problem assets into cash-flowing, passive income machines that will pay them for years to come. That consistent interest is where a big part of their profit is to be made. And if the loan can't be saved, they have a clear path to foreclosure. Because they acquired the loan for about half the property's value, they have a huge equity position. They can take ownership of the house and sell it on the open market. And when it goes to sale, if not bought out by a third party, they'll be able to keep the property, meaning the homeowners will have to forfeit their house and the equity they have in it, allowing the bank to virtually double their investment without lifting a finger. These big money funds can acquire these huge swaths of land because they have the capital and infrastructure to handle thousands of loans at once. They can take on the risk and expense of managing these defaulted mortgages and still come out ahead. It's a strategic, data-driven game that's very different from traditional real estate investing. But here's the most important takeaway. They may be playing on a different level, but it's the same game. The principles are universal. You don't need $1 million to acquire a loan with a low loan-to-value ratio. You just need to know where to find these deals. And you have the same two profitable paths, even more. In fact, as a smaller investor, you have an advantage. You can be more selective, more hands-on, and more personal in your approach. You don't need to compete with multi-million-dollar funds. You just need to understand the same fundamental principles that they use to build wealth. The big funds have their playbooks, and now you can have yours. We've created the Non-Performing Loan Toolkit as your essential guide to understanding the sophisticated market. It contains the exact frameworks and strategies we use every day. Click the link in bio to get your free Non-Performing Loan Toolkit and start creating passive income like the banks.